Hi, I'm Herman van Papendorp, Head of Investment Research and Asset Allocation at Momentum Investments. In today's Minutes with Momentum, I'd like to discuss the shorter-term asset class views that currently underlay our tactical asset allocation process. We have a strong preference for growth assets in our portfolios, particularly for global equities and South African listed property. Globally, both fundamentals and valuations currently support global equities over global fixed income. Fundamentally, global equities currently face a Goldilocks environment. We have a synchronized global economic recovery, which support profits, and the absence of inflation pressures in the system will probably keep monetary policy tightening very gradual. As such, there are very few bear market indicators for global equities. In contrast, global bonds face a very weak fundamental environment. We have had net issuance that have gone from positive territory into negative territory in the last couple of years, underpinning the bond market, but that's now reversing into positive territory after quantitative easing again. Also, net inflows into the asset class since the global financial crisis have been exuberant, and we expect inflation to pick up its head also over the next number of years. Valuations also strongly support global equities over global fixed income. While global equity valuations are trading only slightly above their long-term averages, global bond yields at close to 5,000-year lows cause equity risk premia to be much more favorable for global investors than what the risk premia on fixed income assets are. Within global equities, we have a strong preference for non-US equities. With improving fundamentals in Europe, Japan and emerging markets, combining with very good valuations, giving us a better opportunity to outperform the US equity markets, where relative performance and valuations are at historical extremes. With more than half of the earnings base of the South African equity market currently offshore driven, there's never been a starker contrast between the strong positive global earnings drivers for the South African equity market and the very weak local earnings drivers for South African equities. With synchronized global recovery underpinning the offshore component of South African equities, while the local earnings drivers are pretty negative, with the political environment continuously torpedoing consumer and business confidence. At least South African equity valuations have improved meaningfully in the last couple of years due to a flat market as well as a profit rebound from previous very low levels. The South African bond market faces a similar dichotomy between strong global drivers and a risky local environment. Developed market policy normalization in the next couple of years likely to be gradual, and that should support emerging market flows from the global environment into bonds. While the South African environment looks very favorable for South African bonds within an emerging market risk-return framework, and South African domestic inflation is likely to fall over the next couple of quarters, this should be very supportive for South African bonds up to the first quarter of next year. However, political and ratings risk could derail this positive environment for South African bonds. South African listed properties' relative valuation against bonds have also improved meaningfully over the last number of years. So much so that it now provides a very positive underpin for future listed property returns. I hope that I've been able to give you some insight into the main asset class views that currently form part of our tactical asset allocation process.